Hello and welcome to the Switzer Daily update. And yesterday we learnt that unemployment here in Australia stayed at 3.5% and less jobs were created than was expected. 25,000 was expected to be an increase, but in actual fact employment fell by 14,600 and that still the unemployment rate stayed at 3.5%. Now the fact that we're losing jobs is a good sign that maybe inflation is coming off and therefore less interest rate rises might be out there. Remember, that's a very important issue for the Reserve Bank. They want to see inflation coming down and a softening labour market could be a sign that that's actually happening. Now, Westpac economists have done some work on these numbers and have come up with a surprising revelation that sickies increased by 86,000 to 606,000. Now, this jump is more than 50% higher than the usual figures we would see during this holiday season. And you ask yourself the question, how come sickies are on the rise? Well, there's COVID for obvious reasons. Then of course there's the fear of COVID. And also it's easier to call in sick when you're used to working from home, another post-pandemic trend. Now AMP's chief economist Shane Oliver says there's always that risk that the pandemic with working from home and isolating may have the effect of legitimising in some people's minds to take a sickie. Now, while sickies were the popular excuse for being away from work, reasons like annual leave, flexi time and long service leave actually decreased. Now, what's interesting is if workers take less annual leave, it's a problem for a business because this is a payment they're going to have to make, and the bigger it is in coming in at one particular time, it could put a lot of pressure on lots of businesses. So the coronavirus has certainly changed the world and the attitude of many workers forever, or at least until a big bad recession sees bosses dump workers who've been redefining their working life to suit themselves and not their employers' businesses. Now let's go to the stock market overnight. Stocks fell on the New York Stock Exchange, and the main reason is there's a fear that the Federal Reserve, that's the central bank in the US, is going to raise interest rates too high to try and slow down inflation. The Dow Jones Industrial Index was down 252 points. The S&P 500 was off 0.76%, the NASDAQ down 0.96%, and both indexes are still positive for the year. Now, this is the important point. This is the thinkness going on. And this comes from a guy called Ed Moyer, who's a senior market analyst with Oanda, which is a currency business in the US. He says, despite all the big tech post-pandemic layoffs, the job market remains hot. This is the feeling in the US that they haven't seen sufficient signs to believe that while inflation is falling, it's not falling fast enough. And they keep looking at the job market there. Our job market is giving us some good signs. The job market's not quite giving everyone in the US the feeling that the market is softening, helping bring inflation down. Adding more to this story is the JP Morgan CEO, Jamie Dimon, who's at Davos in Switzerland right now for the World Economic Forum. And this is what he's saying about inflation. He said, I think there's a lot of underlying inflation which won't go away so quickly, he told CNBC. And that's probably a nagging issue for the US economy, ultimately the stock market. That's why the stock market is a little bit negative. So we're going to be watching what the Federal Reserve says later this month when it meets on interest rates. If it raises interest rates by more than what we expect, the market will go down. The narrative, what they say about where interest rates are going over the rest of this year, that will be really important for the stock market. But I still go back to this important point. This market has started off really well this year, and even if it comes off the boil, I think we've seen a sneak preview of what will happen when the belief is inflation is falling considerably and permanently falling, and interest rate rises are over. That's when the market will really relive what we've seen in the first couple of weeks of this year for the stock market. That's my take for today. I'll talk to you on Monday.